You got to chime in on this debate with us here. We continue to hear these Fed officials play down these inflation risks, the transitory effects, as they say, and then the market seems to not so much agree. In fact, they think perhaps there might be other concerns here. Which camp are you in?
We're in the transitory camp. We're obviously watching it as everybody is. We're on a risk-on position, and this is one of the things that we're watching carefully. We think that we'll see something over the next short to medium term. And that is going to cause chop in the market, is what we're expecting. But longer term, our view is that we're looking at a lower for longer universe in which that's going to have profound implications in terms of some of the macro demographic drivers affecting Asia.
How do you think COVID has actually impacted the whole active versus passive investment strategy debate? Do you think that it's put a little bit more faith into active investment and in a way, or do you think this whole long-term trend of going into passive strategies is just something that just can't be reversed?
Well, in the U.S., I think the circumstances that gave rise to passive investment is quite a bit different than what we're seeing here in Asia. Active management is still at a premium. And again, what I would suggest to you is that given the investment needs of the population that we're serving, active management is core to help them achieve their financial objectives. I would say that is particularly important in an environment in which the population is aging very rapidly.
Michael, the trading environment today is very different from a year ago. Has that prompted any change in strategy? I mean, and also on the back of that, what changes do you see as permanent?
Okay. Well before COVID, Asia was the most rapidly aging region in the world. Over the next 35 years, we'd expect to see 19% growth in the overall population, but 155% growth in the aged population, people over the age of 60. We're driven by that, and we're focused on that. That's what drives a lot of our behaviors in the marketplace. COVID will not change that. It's a common thread that cuts across the entire region. The safety net that helped people in the past, these multi-generational households where adult children were taking care of their aging parents, is breaking down. Is breaking down because of declining household size as well as urbanization. What COVID has done, COVID has exacerbated it. What we see from our surveys is that people have moved from a 38% cash position to over 55%, a survey of investors. But at the same time, it goes back to my earlier comment. We are looking at a lower for longer world in which bank deposit rates are not serving the customers terribly well. In most markets across the region, they're earning a negative real return.
I'm wondering the kind of opportunities you see, especially in light of the Hong Kong Wealth Connect. What are you looking at?
No, we see that as an enormous opportunity, as most industry players would. 70 million people, accounting for only 5% of the total population of China, but 12% of their economic output. We think, based on our experience with mutual fund recognition, the southbound traffic is going to be much more significant than would be the northbound. So that is mainland Chinese investors buying Hong Kong managed mutual funds. So we think that the regulator is going to first emphasize lower risk products. That suits us fine, being amongst the region's largest managers of Asia fixed income. But if you take a step back, this is just one arrow in a much broader quiver. We're already very, very active in terms of the cross-border space. That would be Stock Connect, Bond Connect, QDII, QDLP, QV, is all these things percolate through the assets that we manage today.
Is there anything that can be learned from the Stock and Bond Connects, Michael? I have to wonder, back in 2015, they had the whole Hong Kong-China MRF, and people say that pretty much was a bit of a failure at that front. Is there anything that's different this time around that perhaps makes this whole venture a little bit more substantial?
I think this is going to be a patience game, just like MRF is. This is going to play out over an extended period of time. I also think that you cannot confine your activities to just Wealth Connect, the Greater Bay Area. It goes back to my earlier comment, is China is a much broader opportunity in terms of that cross-border traffic. Toward that end, November of last year, we acquired a minority stake in a company called Ableman, which specializes in clean energy, renewable energy, as well as data centers. They're going to be involved in raising money both within China, but also in terms of bringing capital into China to invest in China's infrastructure.
Interesting. Of course, everyone sees this as another step into China opening its capital markets. Is there more that you would like to see from regulators, Michael, in order for more money to really flow through?
We think that the really big issue facing China is in the headlines lately, is the aging demographics of China. The pension reserves within China are inadequate for the trends that we're seeing in terms of that population aging. Pension reserves to GDP is less than 15%. China has embarked upon this program of liberalizing their pension system. They gave rise to the Pillar 3, the pension retail mutual fund space. That's a space that we're extremely active in. One of the things that we'd like to see from the government is clarity in terms of the tax position for those Pillar 3 instruments. And we think that the market would significantly expand on the back of that.
Another concern when it comes to investing in China of late is the Huarong debacle. What's your own assessment there?
Credit is a huge deal. To begin with, just some background, we're probably about the largest player in the Asia fixed income space. China is about 40% of that benchmark. It is a pure credit play. The local rating agencies probably don't serve the market the best. Sometimes things are AAA until default. You have to have a large on-the-ground credit team within China and Hong Kong to properly play in that market space. It cements what we've believed all along in the context of rising bankruptcies and defaults in China, that with the breakdown in terms of this moral hazard support, China's going to let more companies fail. And so you have to be top of the game in terms of how you analyze that risk and not impute too much implied government support to these borrowing entities.
Michael, we've seen a lot of banks, a lot of firms that are eyeing expansion in the Greater Bay Area now in preparation for this Wealth Connect. I'm wondering, what are the plans for Manulife at this moment here? Are you looking to increase your presence in the region?
You bet. It's on two fronts. We're both a life company side. We greatly benefit from our on-the-ground presence within China through our 51% owned JV, Manulife Sinochem, and so I know that they're making aggressive moves to position for the Greater Bay Area, as are we. As I said before, we think it's going to be low-risk products. Southbound is our focus, and so we're obviously in discussions with banks that traverse both the Greater Bay Area as well as Hong Kong to position ourselves for that business.
I know some of your largest markets include the likes of Singapore, high growth markets in Southeast Asia like Indonesia and Malaysia. I have to wonder, with a Wealth Connect now, do you think that Singapore loses out in any way? Do you think that you see less money flowing to Southeast Asia?
No, not at all. Singapore is vitally important to us. Singapore's importance rests on the fact that it is a high net worth center. Asia obviously is eclipsing Europe in terms of the amount of high net worth AUM in the marketplace. On top of that, we obviously have a REIT that's listed on the Singapore exchange that will be completely unaffected by Wealth Connect. And increasingly, I think you hit the nail on the head, is ASEAN is a hugely important high growth market. We have a presence across the region, and Singapore is kind of like a complementary hub for us to oversee the expanse of our our investments across that ASEAN region.
So just to follow up on that then, Michael, what are the growth plans for Southeast Asia?
Southeast Asia, just like North Asia, is being affected by this aging demographic that I mentioned at the outstart. Pension reserves are inadequate for the tsunami that's coming in terms of that population aging. Our main focus are twofold. One is to make sure that we're mobilizing the overinvestment in bank deposits and coaching that money into income theme strategies, equities, fixed income, multi-asset strategies. But at the same time, across the ASEAN region, we are not just dependent upon intermediaries for distribution. We have Manulife as a whole has over 12 million customers across the region, spanning insurance, pension, investment-linked platforms, as well as mutual funds. And so the other big opportunity that we see is digital tech. And our digital tech is focused on our signature application called iFunds, which in the COVID environment allows our agents as well as our customers to engage directly and manage their portfolios without face-to-face contact.